Hi friends, based on market capitalization, SEBI classified equity mutual funds into 5 types. Present video is about large cap equity mutual funds. On market capitalization topic, I made a separate video. Link is available in the description box. According to market capitalization, SEBI classified public limited companies into 3 categories. Large cap category, mid cap category, small cap category. First 100 companies with the highest market capitalization come under large cap category. These companies are well established, reputed and had been in the market for a long period. They are the branded companies and most of the Indians use their products daily. These companies are generally the leaders in their field of business. The shares which are sold by these companies are known as blue chip stocks. Second one, mid cap category. Mid cap companies are those which are ranked between 101 to 250 in the list of companies according to market capitalization. Third one is small cap category. These are young and smaller sized companies. 251 and above placed companies based on market capitalization come under this category. Now come to our present topic, that is large cap equity mutual funds. Asset management company launched one large cap equity mutual fund scheme and company is able to collect 60 crore corpus from 10,000 investors. And present NAV of 1 unit, net asset value of 1 mutual fund unit is 12,000 rupees. The fund manager of AMC must invest maximum portion of this corpus in large cap company stocks. Here maximum portion means minimum 80% of this corpus should be invested in large cap company stocks and the remaining 20% of corpus money fund manager may invest either in mid cap company stocks or small cap company stocks or both. So what do you mean by large cap equity mutual funds? If a maximum portion of corpus is invested by the fund manager in large cap company stocks, then that mutual fund is known as large cap equity mutual fund. So related to this fund, there are some important points which you should keep in mind. First point is, these are considered to be the least risky. Assume that fund manager of this company invested total corpus money in stocks of 70 large cap companies. As these companies are well established and had been in the market for a long period, the NAV of these units doesn't fluctuate because of up and downs in the market. Thus, these funds are tend to be less volatile compared to mid cap funds and small cap funds. These funds are capable of withstanding bear markets. Means even though market crashes, the NAV of one mutual fund unit doesn't decrease much. Even though there is a loss is not too high. Thus, these large cap funds are suitable for the investor who is risk averse. Means an investor who cannot tolerate risk can opt for these funds. Now the second point is, you cannot see a high growth in NAV of your units. I will explain this point with simple example. You have joined in one college as junior lecturer. If you work hard, then there is a chance of getting a promotion, that is senior lecturer. Then you can expect a further growth, that is becoming HOD. Next position is vice principal, then principal, and finally you can be a dean of that college. Once if you reach that highest position, even though you work hard, there is no chance of further growth. No? Only the thing is you have to maintain that position. Now same thing is applicable to these public limited company categories also. If we take them in pyramid, then bottom portion is allotted for small cap companies. We can show mid cap companies in this middle portion, and here you can see large cap companies. Come to small cap, these are new companies. People don't know about these companies, therefore their one share market price will be very less, and if they perform well, there is a chance of increase in market price. As a result of that, their market capitalization value increases and they will be promoted to next stage, that is mid cap. And a company which is in mid cap category, if it works hard, if they show better results, then they will be promoted to large cap category. And once if a company reaches to large cap category, then what happens? Their market price of one share will reach to a maximum limit. In our example, this corpus is invested in 70 companies now. As these companies come under large cap, already their share market price reached to a maximum limit. Assume that these 70 companies, one share market value is above 50,000 rupees. And NAV, net asset value of one mutual fund, depends on market price of one share. As a market price reached to maximum limit, NAV of that fund scheme will be high. To acquire these scheme units, already investor paid a high amount of NAV per unit. So even though market conditions are favorable, even in bullish market, an investor cannot expect much capital gain. He cannot expect a high increase in NAV of one mutual fund unit. Suppose one investor, Tarun, purchased 50 large cap equity mutual fund units at the rate of 12,000 each. So one unit NAV is 12,000. So his investment in this scheme is 6 lakh rupees. Assume that there is bullish market. Even though he cannot see a high increase in his NAV. Assume NAV is increased from 12,000 to 12,070 rupees. There is an increase of only 70 rupees per unit. If he redeems his 50 units, how much money he can expect from AMC? 6,03,500. So there is a capital gain of only 3,500 rupees. So remember, in case of large cap equity mutual funds, investor cannot see a high growth in NAV of his units. Thus, it is suitable for an investor who is aiming stable returns. You can expect only a moderate returns in case of these funds. Why returns are moderate? Why returns are not too high? Because risk is moderate. When you are not taking much risk, you cannot expect much returns. Now the third point is liquidity is high. As these 70 are grown companies, always you can find a seller if you want to purchase these fund units. Similarly, you can find a buyer if you want to sell these units. Means always you can see a ready market for these funds. Whenever you need, you can purchase them. Whenever you want to sell, you can redeem them. Now come to last point. Large cap mutual funds are suitable for, first 2 points are completed. Come to third point. These funds are suitable for the investors who are interested in long-term investment. Remember, in short term, you cannot expect much returns from these funds. They are suitable for long period. If you can stay invested for 7 or more than 7 years, you can expect returns of around 10 to 12%. Why they are profitable in long period? When market crashes, large cap mutual funds also experience underperformance of their portfolio. However, this underperformance itself averages out in long period. Thus, in long period, investor can see a capital appreciation in his investment. So finally, remember, large cap equity mutual funds are suitable for the investors who are not willing to take much risk, who are expecting stable returns, and who are interested in long-term investment. This is all about large cap equity mutual funds. Hope this video is informative. Thank you.